Welcome, Anders. Nice to have you back in the studio now after the summer. I heard you speaking this morning with our investment teams and bringing up a focus on both BNP and growth. And we are very keen to hear your thoughts on the summer's markets and development. So if we jump right in, starting with the US, it was a strong but bumpy summer in the States in many ways. And the government just announced it will buy back some more long-term bonds. What does this mean, and how is the situation in the US?
Well, I don't believe in government interventions in really liquid markets when you're going against your fundamentals. Whether Besant is intervening in the yen or in the 10-year government bond market, it won't work if you don't underpin it with fiscal and monetary policy. And obviously, the US Treasury is still pushing out $1 trillion in government bonds every month. So. You can have an intraday impact, and maybe you can do a trade between Warsh pushing interest rates up and Besant trying to push them back down again. But fundamentally, the US economy has had a really good summer. Productivity numbers remains very strong. We have a strong capex-driven growth, and in terms of inflation risk, if you have an economy that is driven by productivity and capex, there is a much lower inflationary pressure. I think we should note that unit labor costs in the US are now below 2%. So I'm not convinced about the money market's pricing of policy rates. I don't think we will see a lot of rate hikes. You could obviously see one coming, but fundamentally I think monetary policy is going sideways, and if there is a direction on maybe 2 to 3 quarters perspective, I do think that the rates are more coming down than up. And I mean the US Q2 reports were spectacular. Sales is very healthy, even if you go outside of the tech companies. Margins are spectacular. So earnings per share growth in the US, I think, is really decent at the moment, and the outlook for next year is actually also very decent. So the US economy, I think, is in great shape, but we do have 10-year bonds going up and 30-year bonds going up. But I do think that that's basically because the auctions are putting a lot of pressure on demand. If you put out $1 trillion in debt every month, there will be some yield to pay. Otherwise, nobody will pick up these bonds.
Turning to Europe, then, we've seen that Europe has had a perhaps surprisingly resilient summer. How is Europe doing, and how is it poised for the fall?
Well, I think there is a couple of points why Europe is coming back a bit. First and foremost, oil prices did not hit consumption. We've seen savings adjusting, so consumption has remained pretty decent. We have also seen that the peak of inflation was in May. The July number were actually pretty decent. So the persistence risk from inflation due to the oil crisis, I think, is a little bit behind us. If you look at the underlying productivity, it's not spectacular, but given that we now have a softer employment growth in Europe, we're actually seeing a bit of a productivity pickup. So even in Europe, the Q2 reports were actually pretty convincing. Banks are doing well, and the broader manufacturing sector is coming back a bit. So I'm not always bullish on Europe, as you might know, but this time I actually think there is a bit of signs of life in the European economy.
And then we have emerging markets. There we've had some mixed results during the summer, with some strong growth and then some being really squeezed by probably primarily rising energy costs. If we think about, we saw a lot of large swings in the AI sector and causing big moves in markets like Korea. What's your take on all this?
Well, I think first and foremost, we need to note that also in Asia, this is a supply-driven growth. You have capex boom in China and Northern Asia. You have pretty decent productivity numbers, to some degree driven by capital deepening rather than total factor productivity, but anyway, decent productivity. And this is not only true for China, it's also Southeast Asia. it's South Asia in terms of India. So the underlying growth in Asia is pretty decent, and it's not really deflationary. We should note that what China is doing with a 24% export increase and a 0.5% inflation is really exporting deflation to the rest of the world. And if you look at the 24% in exports, it's mainly driven by new technologies, batteries, EVs, but also a very large AI component. So in spite of Trump's ambition to cut China out of the AI trade, it's pretty clear that they are exporting everything with the exception of the most advanced GPUs that you need for AI. There's been quite a lot of turmoil, not the least in Korea and Hynix. If you take a step back, I think that's more to do with stock market dynamic, leverage and margin calls, whatnot, than it has to do with the underlying demand. If you look at how AI is scaling out, it is pretty clear that we're in the beginning of that trade. We saw from Microsoft, Amazon, and Google reports that the AI part of their revenues are growing very healthy. We are later going to see Nvidia, but I'm pretty convinced that will indicate that the AI trade is on. So I think that has more to do with the stock market running a bit wild and pushing the Hynix price a bit too high than it has to do with any fundamental issue with the AI trade.
Sounds like we have a lot during the fall to continue discussing when it comes to emerging markets. If we turn to Sweden then, Sweden had a really strong summer, outpacing growth in the rest of Europe, and that was nice to see. With today's Riksbank's decision in focus, how do we see Sweden coming into the fall?
Well, the Riksbank presented their report today. If you take the numbers and dissect them a bit, this is also growth driven by productivity. Our National Institute of Economic Research and the Riksbank are closer to 1.5% productivity growth. It is clearly quite a lot of capex, and let's note that it's not construction sector capex or real estate capex. It's more real capex that we could see in the economy. There's been a lot of tax cuts, so demand is supported by this. Is not driven by consumption. It's more about productivity and capex than consumption. The Riksbank is indicating that there might come another hike. I'm not convinced. They might be forced to do it given that ECB has this Bundesbank heritage that makes them a bit excessive hawkish. But for ECB, Bank of England, Fed and the Riksbank, I think that the situation is kind of pretty decent. There is not a lot of inflation pressure when you have unit labor costs growing in line with or even below 2%. So I think the money market is a bit too hawkish in their pricing on monetary policy. So in my world, that pricing will be taken out, and that could also give a bit of support for stock markets going forward.
Great, thank you very much for that update, and we look forward to talking to you more as we go into the fall here now.
Thank you very much.